This is the Veterinary Project Podcast, episode 117.
Welcome to the show created by vets featuring absolutely no pets. This is the Veterinary Project Podcast, hosted by Dr. Michael Bugg and Dr. Jonathan Light. Our resident veterinarians have swapped out their stethoscopes in favor of microphones to bring you the Veterinary Project Podcast, a show focused on real conversations, aimed to connect this amazing profession full of remarkable people. Through the sharing of collective stories and wisdom, and connecting over the many unique challenges we face, we invite you to join our community of veterinary professionals leading intentional lives. And now, here are the hosts of the Veterinary Project Podcast, Dr. Michael Bugg and Dr. Jonathan Light.
Hey everyone, welcome back. Another episode of the Veterinary Project Podcast. Flying solo again behind the mic, but I do have a guest this week. Isaiah Douglas is joining us again. You may remember him. He's been on the show a few times, most recently at the end of June. So June 2022, we had him on kind of for a state of the economy, and we invited him back just because 2022 has been such a strange year. We thought, we're due for an update. As we dive into the conversation, I'm kind of a money nerd, so we get a little bit deep on some stuff. I kick us off with an excellent story I recently heard about a hot dog stand in New York. And I think that has a lot of parallels to the veterinary industry, and kind of building off last week's episode with my mini investing rant. Before we dive in to the bio here for Isaiah and get into the conversation, I mentioned this in my conversation with Isaiah, but I think it's worth mentioning here again in the intro. My intention with these sort of economic and money episodes and guests that we bring on is simply to try to provide knowledge and value to the veterinary community. I know these things can be heavy, and by no means, my intention with these episodes is not to spread fear and not to play into the doom and gloom that can be out there. But I also think, money and health, those are kind of two areas of our life that are going to affect us whether we pay attention to them or not. And so that's the reason why, we keep coming back to this, because it's really important stuff. One of my sort of dreams and wishes for the veterinary community is that, veterinarians, veterinary techs, veterinary receptions, everyone involved in the industry can just have a better handle on their personal finances. And I really believe that can help unlock, more joy in life. I am not at all saying that money is the most important thing. I'm just saying when we can take care of that basic level, it does make other things easier. So that's the intention behind all of the money episodes, bringing Isaiah back on. We do get into some stuff, that is pretty heavy, pretty technical, to be honest. I'm definitely not an expert when we start talking about bonds and all that stuff, but that's why there are financial planners out there that you can reach out to. So anywho, I hope you get value from this. Isaiah Douglas is a certified financial planner, certified exit planner, and fee-only advisor. He left a large national firm to found a solo financial planning firm in 2018 to pursue a planning approach that is dedicated to identifying ways to grow the net worth of veterinarians. In the summer of 2020, Isaiah merged with another financial advisor and became a partner in Vincere Wealth Management. Isaiah is also the host of the weekly podcast, the Veterinary Success Podcast, which interviews and discusses topics related to the clinical, business, financial, and personal lives of veterinarians. I hope you enjoy this conversation. I hope you enjoy the story about the hot dog stand. I give you Isaiah Douglas. All right, Isaiah, thanks for joining us again. We had you on, I think it was in June. So 4-ish months ago, about a third of a year. It feels like, economically speaking, we've had way more action than just sort of a third of a year, but happy to have you back and shed some light on the current situation.
Yeah, it's 2022 has been just wild, and it's just super interesting, where every time you think, wow, this year's been wild, something else comes out and you're like, that's insane. I don't think that can be topped, and somehow something else happens.
It gets topped. Yeah. And even at the time that we are recording this, literally an hour ago, I jump on social media and all you can see is doom and gloom, right? And I don't want to spread misinformation. It's just as an example, it was on Twitter where it was like allegedly a Russian rocket has hit Poland, right? And I have no clue what the real facts are behind this because it's way too fresh. So I'm not spreading misinformation on it. Like, I have no idea, but it just blows up and you're like, what is going on here? And it seems like every week, every month we have, these stories that are like, this is the biggest story of the year. And like you said, hold my beer. Next week, there's a bigger one. So diving into this for our listeners, I have to be honest, I confessed to Isaiah before we hit record, I'm a little bit conflicted with episodes like this because what I'm not trying to do is I'm not trying to spread doom and gloom to the veterinary community, but I want everyone to be educated, know what's going on. So to kick things off, I'm going to share a little fable, and I have to give credit to Megan Sprinkle, who was a guest a few weeks back. She tipped me off to this, so I went and looked it up, and I found it pretty fitting. So there was an old man in New York City who ran a hot dog stand his entire life, right? He's a local legend. If you go to New York, talk to a local, you say, hey, what do I got to do here? They say, go get a hot dog from this guy, right? He'd been doing it his whole life. He had it down to a science. So you go there any time of day, doesn't matter. Huge lineup at his hot dog stand, the best, freshest bread, top quality hot dogs, this special kind of like mustard sauce, like everything about it. His interaction with his guests has them all laughing, feeling good, knows all the hot spots, right? In the morning, he's there when you get off the subway with breakfast options. At lunch, he's at the park, hits the afternoon rush. And in the weekends, he even, modifies his hot dog cart and goes to the nightclubs and the bars, has neon lights, and hits up the after bar crowd. And by all accounts, like, he is absolutely crushing it. Financially, he loves what he does, goes home at night, reads his book, doesn't go online, doesn't go on the internet, no social media, doesn't watch the news. Everything is fantastic. Then one weekend, his son comes home. So his son had went off to university, highly educated, in the corporate finance world, climbs the corporate ladder, and sees his dad getting ready for next week and doing some ordering. He says, Dad, what are you doing? He said, well, what are you talking about? I got to get my supplies ready. And he's like, don't you know there's a recession? He's like, you can't be spending that much money on bread. You can't order the top quality hot dogs. Like, you got to peel that back. You got to cut expenses. And so his old man is like, well, I have no idea. This is literally the first I've heard of a recession. Like, business is booming, but he trusts his son. He loves his son. So he thinks, okay, well, yeah, I'll peel back. I'm not going to order, as much. I'll tone down on some of the quality. And that week he's out behind his hot dog stand, and, he's just a little off, and he's like talking to his guests. He's like, have you heard of this recession? And his mood has changed. He's not telling jokes anymore. And this keeps kind of playing on, and he doesn't notice an immediate change, but all of a sudden his lower quality bread, his lower quality hot dogs, his change in mood, and all of a sudden people stop coming, right? There's no longer a lineup. Their business is getting a little slower. And he says, holy shit, there is a recession here. So he thinks, well, if there's less people, I'm not going to show up as early. I don't need to do that breakfast option anymore. People aren't going out anymore. So I'm not going to hit the Friday night crowd, the Saturday night crowd. His neon sign breaks on his hot dog stand. He says, you know what? I'm watching my costs. I'm not going to replace that, right? I'm not going to fix that. And this keeps going. And he looks at his numbers and they're down, down, down. And, he's getting desperate. And then one day this lady approaches him and says, hey, I run the hot dog stand over there. We're looking at expanding. Would you like to sell your hot dog cart? And he's feeling desperate. And he thinks, this is my only chance to get out. So he's like, absolutely. And takes her first offer, sells the hot dog cart, goes home, turns on the news, and just headlines about the recession. And he's like, there is a recession. And that fable, when I think of that, it's very interesting because I feel like we can't ignore, economic reality. But I sometimes think all of the media, we play into that, and it almost becomes like a self-fulfilling prophecy. So I kind of wanted to just kick us off there, Isaiah, and get your thoughts. And then specifically for the veterinary industry, how much attention should we even really be giving the current economic climate? Or should we just do like the old man used to do? Stay off social media, don't watch TV, and just do our thing. So I'd love to get your thoughts here jumping in.
So first, before we click record, I mentioned that our team got together recently. So we went to Nashville, and we went out in Nashville, and it was Thursday night. We went to Broadway, which is the main strip. But if anyone's ever been to Nashville, they know that spot. And it was unbelievably busy. It was insane. I'm like, recession in Nashville. This place is crazy, right? And because we thought, oh, it won't be as busy. We don't want to go Friday or Saturday because it'll just be wall-to-wall people. And it was still wall-to-wall people on a Thursday night. And I was, I guess, not surprised maybe, but yeah, I think there's some truth to that. And we talk about internally in our team, like, you want people to be able to see what's going on and eyes wide open, but you also don't need to have this big black cloud that of fear that then everyone is trying to hide from, because it's likely never going to be as bad as everyone says. But you also need to remember that when it's not going to be as good as everyone says either. And so I think it's true on both sides. And what I would tell folks within veterinary medicine is, and what I've heard, and this is across the country, whether it's in the Southeast, whether it's in the West Coast, wherever, I'm asking, hey, how long are you booking out? What are you seeing? And softening demand has been consistently the story across the country. I continue to hear that. And I've had guests on my podcast, and they've said the same thing. That are consultants that are talking to people. They're consistently seeing it's a little softer, it's slowing down a little bit. But slowing down a little bit is actually not that bad, because everyone was running around like a chicken with their head cut off for so long that this reprieve might be good. And so it might just be one of those things where you need to get back to, hey, you need to execute really well if you're going to be a good business. You can't just fling open the doors and just be booked, till next year, right? You all of a sudden have to start doing the things again that you were used to doing. Maybe pre-pandemic, maybe you need to spend money on marketing again. Holy cow. Someone actually spend money on marketing, or maybe you do need to be a little bit more thoughtful around, certain aspects of your business. But most people have raised prices somewhere between 7 and mid-teens over the last year. And they've not really seen a huge slowdown, because most people are expecting prices to go up in every other aspect of their life. And so what I would tell someone that is either working in veterinary medicine or as an owner, the recession is going to come when you're a service business. But, depending on where you are, you'll probably feel that a little differently. We have clients all over the country, and our business also has, an aspect of it that is completely non-veterinary related. It's more in tech, because that was my business partner and some folks on the team. Tech is getting hit really hard. So if I'm a practice in the Bay Area, it's going to affect me differently than if I'm in Noblesville, Indiana, which is where I'm from. Because there's a lot of people that are getting laid off, and you're seeing it in the news with big tech companies that you're seeing large layoffs, right? And so maybe that is going to impact you more in those areas, depending on who your clientele is. Or maybe they're going to not pay as much because they're trying to find that other role, or they're moving away. So, my crystal ball, Mike, is just like yours. It's in the shop. It's getting fixed. So, we'll see. But I would much rather encourage people to look at the facts, look at what is going on, and take in perspectives from different areas, and then try to filter that as best as possible, and then go from there.
Yeah. Interesting. So I have an episode, there's no way you could have heard it yet because it hasn't come out yet while we're recording this, but in there I say, you can choose to participate. Now, this is speaking more to the veterinarian, not to the veterinary business, right? And I was kind of coming at it from a mindset of, as individuals, we can sit there and we can look at like the doom and gloom, or we can sort of pivot and start looking at like, there's always, an area to pivot to and areas of opportunity that arise in these situations. So I guess first I want to bounce that off you. Like, would you agree, or what would your take on that statement of like choosing to participate in a recession, that you can just choose not to?
Yeah, I mean, you don't get to make the decision of whether there's a recession or not. Like, it's going to happen around you. You get to choose what you spend money on, and the trips you take, the house you buy, the car you buy, all those other things. And so we're at this turning point in, like a business cycle or a market cycle or whatever, where, 30-year mortgage rates were 3% last summer. They are now north of 7%. And so the affordability of those homes is drastically different, because the asset price itself is not reset. And what I mean by that is the home prices have not readjusted to that higher interest rate, because it's becoming as unaffordable as it's ever been in the United States. And Canada, I know, is just as bad, if not worse. And I know it's actually slightly worse based on conversations with some
significantly worse.
Significantly worse. So the Americans can complain all we want, but Canada's insane. But like, so you can choose to just wait on that home. And I know that people have been waiting maybe since 2020, and they're like, well, it hasn't got any better, I'm just going to pull the trigger. So you're buying the top of the market at the highest rates we've seen in a long time. Yeah, that's foolish. So you shouldn't do that. You shouldn't do that. And the same with used car prices, which have kind of held up outside of the last, like, call it 3 months, better than probably anything from a price appreciation standpoint. Just wait a little bit on some of these decisions. If you can stretch a little bit longer, I think there's going to be opportunities. And I think that being patient has been the biggest thing that I've encouraged people on those big ticket items, because a lot of people are just going to say, well, it's not going to change. Inflation, like we're just going to push on forward. And maybe you can, because you have, confidence in your income and what's going on. And especially within vet med, I don't think all of a sudden you're going to see this unemployment rate of veterinarians go through the roof. Like, that's not going to happen. There's some big macro, like big picture things that are happening, that being in vet med right now is awesome. You have so much more security. If God forbid something happened, plenty of people looking for good help. So you will be fine. What I'm saying is, you can just make one of those mistakes on those big ticket items that then you're stuck with that payment for a long time. And sure, you're gonna be like, oh, I'll just refinance. Well, what if rates don't come down as much, and all of a sudden, fast forward to 3 years later, and your house poor because you can't go do the things that you wanted to do? And so I would just try to prioritize what it is that you really are solving for, which again is kind of the idea of financial planning, is just like aligning your interests with what you actually deem most important, and then what are the resources that I have at my disposal. And yeah, just because interest rates are ridiculously high doesn't mean you shouldn't buy a house, but if you have to make that decision. But a lot of people don't have to, and it's a desire and it's a want. And I think if they give themselves a little bit more space, they might have a better opportunity. Now, again, is that 6 months? Is that 18 months? I don't know the timing on that. That's ridiculously hard to make that prognostication.
Yeah.
But I would. But yeah, still take vacation, still go out to eat, still do those things that you want to do. As long as you're able to save at a decent rate and continue to, do the things that are responsible, good. But yeah, as the costs kind of continue to compound, all of a sudden you have to like cut something, and you're like, well, I don't want to cut out anything in my life, so I'm just going to cut out what I'm, holding back or saving or doing this. That's when you need to start reevaluating things. And I guess that would be my initial thoughts there.
Okay. Oh, I have so many tangents I could push us off. First, I really like what you said. What are you solving for? Like, getting clarity on what your financial goal is. I was thinking of you in Nashville and thinking about how easy FOMO is. And it's like, I could picture myself being like, there's Isaiah in Nashville. That looks sweet. That looks fun. I want to go to Nashville. And it's just so easy for that, like those expenses to creep up when you see it all around you. So that, what are you solving for? What is the biggest, most important thing in your life? I think is very important to get clarity on. I'm curious, maybe more tactically now. Last time we had you on, you had said that the things that veterinarians can control, their saving rate. And then you had just mentioned, if things start to get really tight, and then, okay, we decide, okay, I normally save 10%. And I put that into investing, but I'm going to chop that off now just because times are tight, just temporarily. What would you say to that, right? If someone is going to employ that strategy?
Yeah, I think it eventually it's gonna bite you, right? Maybe you've done a fantastic job and you've oversaved and you can't afford to cut back on that. So I'll give an example of a client where they've been really diligent savers, and like for them, their kids. They have 4 kids and they're in a spot where they only have so much time until their oldest gets to high school, and they want to travel and do all the fun things. They are prioritizing that over saving in this season of life. That's great. But it's different if you're 2 years out and you haven't really saved for as many years as maybe they have, and you're already making that sacrifice when you've told yourself the most important thing is, XYZ, right? So now what you're prioritizing is this short, time preference, which I like that idea. And it came up in a podcast recently. It's this short-term time preference of the same for the future is hard, right? Like I don't want to take a long-term view on this. I'm gonna prioritize what feels good or what I want right now versus the future you that's gonna be like, darn it, Isaiah, you should have kept saving. Like it's gonna give you that flexibility in the future to do some cool things. And sometimes making those hard decisions when you see, let's use Instagram as an example, right? The Nashville trip. You see the best 10% of everyone's life. And so you're always going to be chasing that. And you just have to come to terms with like, that's not real life. So much of what people show you is just complete fake BS. And I think as someone that talks about finances with a lot of people, and I get a lot of clarity and glimpses into stuff, everything, going back to the same thing with like the recession, everything is not as good as it's shown, but it's also not as bad as, things are as well. Like when people are like, oh, I could have done better. It's like, well, sure, everyone can do better, but you're actually not as bad off as you think versus the person that you think is like just crushing it. It's like, well, they actually have a lot more debt and, maybe they don't pay down their credit cards all the time. And maybe they have these extra things that, happen, or, maybe they had some sort of inheritance or this thing that happened in their life that is not, it's not their own doing why they got to where they are. And I think that is really interesting as you see things over time as well. So,
yeah. I'm trying to remember. I'm sure we've tossed around the name Morgan Housel and the psychology of money. And one of my favorite lines in his book is wealth is what you don't see. Right. And I think of that in what you just said is we're all comparing ourselves to other with what we can see. And that's usually not the accurate measure of how wealthy the person actually is.
Yeah. Morgan, I think, talks about everyone says they want to be a millionaire, but what they actually want is to spend $1 million. There's a big difference in that. So let's say it again. So everyone wants to be a millionaire, but what they actually want is they want to spend $1 million because those are two very different things.
Yeah, absolutely. Okay. So I guess tactically, maybe for people listening, we are where we are. We can't control the overarching macro, economics at play. We have, a stable career. We're in a fortunate industry. We have income coming in. What might be some things we want to be thinking about or looking at or moves we could make, to come out of this ahead, right? Like this doesn't have to be a disadvantage. What are you advising your clients, strategically?
Yeah. So I think the biggest challenge is for most people, the bulk of their savings are in probably some sort of retirement plan that's associated with their job. Right. And so in the States, and I always default there because I don't have as much clarity into everything up north, but it's from what I've understood and had conversations with, it's pretty similar. Most of the retirement plans, a 401k at your employer. So the Department of Labor made some decisions over the last 10 years that basically anything other than stocks and bonds are bad, and that cost is all that matters. So super low costs, stocks and bonds only, that's what you get. So fast forward to 2022, and you have a year where interest rates the rate of change is as high as it's ever been. It's moving and screaming higher. You have inflation at 40-year highs. What has that done? It's wrecked stocks and bonds. So for the first time, and this is going back to the 1960s. So a 20-year US Treasury bond, historically, when the S&P 500 is down 20% or greater, has been that kind of flight to safety. So S&P down 20% or more. So the stock market, that's in a bear market, down 20% or more. Usually what happens is that 20-year long duration, or that long bond, that 20-year Treasury bond is up. That's the ballast, right? That's the thing that zig and zag. Enter 2022. Stock market down 20% or greater, it's down 30 because of the inflation and the interest rate challenges. And so for the first time, you've seen the stock and bond, that yin and yang go yang together down to where a 60-40 portfolio is having its worst year in 100 years. The last time it was this bad is 1937. 2008 didn't even see the 60-40 portfolio drop this much. And so for a lot of people, they're looking at, well, shoot, I thought if I wanted less risk, I own more bonds. And it's like, no, not always. It depends what environment we're in. And for most, I would say most advisors, they have never managed money in this environment. And I beat up on my peers for just recommending, hey, all you need is stocks and bonds. We have 100 years of history, all this other stuff. But then they fail to look at, well, you're still seeding risks where stocks and bonds can go down together. And yes, we've been fortunate since the 1980s that you've seen interest rates fall and fall and fall and fall. And that's been a benefactor to bonds. And the stock market's done pretty darn well during that time frame too. Well, all of a sudden it changes. And so the question is, what do you do to protect yourself? What do you do to complement that? I always use ingredients in investing. Think about like the cupboard at home. Like I'm going to go cook some things. If I only have 2 ingredients, it's hard to make a lot. You can still make something pretty good, but it's hard. And those can still be core ingredients, right? But you need some other things to complement that. And the biggest complementary thing that has been left for dead has basically been anything commodity related. So when I say commodities, think, oil and gas, gold, copper, silver, these type of things that are out there. And you don't have to pick the right one, because I've had people reach out like, oh, I heard I should buy silver. Like, how do I do that? I need to go buy all this stuff. I'm like, whoa, let's pump the brakes. Let's understand what we're doing here. But you can buy like a basket of commodities, and commodities are up 26% this year, right? And so there are ways in environments to take advantage of things. And if you look at commodities since 2009, at the coming out of the great financial crisis through 2019, they annualized a negative 5% return. Like, commodities were horrible. They were awful. You lost money almost every year. No investor in their right mind was going to continue to hold those. And so to me, it's hard for anyone that is trained that you just buy an asset, you hold it, you save into it forever, to then experience an environment like this, because it's like, well, that's not what the chart showed me. When I own stocks and bonds, they just go up, or one of them's going up, and now all of a sudden they don't. And I think that is the biggest thing. So going back to the retirement piece, there's not a whole heck of a lot you can do in your 401k. If you're a younger individual, to me, owning bonds, that's not really adding any diversification. It's adding more risk than anything, especially if you have a longer time horizon. I would rather be saving into the stock portion of it. I'm not saying, don't own any bonds. I'm hinting at maybe don't own any bonds, but so the way when you think about bond, it's a debt obligation. And when you think about a debt obligation in a world where, nation states and companies have more debt on their balance sheets. So think about in your personal household, way more debt versus income. That is how most companies, and that's how most governments are at the moment. And all bonds are saying, hey, we'll pay you back this rate over a certain amount of time. And if inflation stays higher, you may actually be earning less money over the course of that period. And I think bonds are just a good way to see good money just go and end up being at a negative return. So I've been very anti bonds for a while, but this is a year that has made that call look right. Now, by no means, again, I said crystal ball's broken. I don't have all the answers, but you can just look at mathematics. So bonds are very mathematically driven. You can look at, okay, what am I going to get paid? How long is it? And what does it look like from there? And then the best case scenario with a bond is that you make your money that they say they're going to pay you, and you get your money back at the end of it. And a lot of times that's still a negative return in the environment we're in. Mm-hmm. And so if the rate that a bond is going to pay you is less than what inflation is, why would you want to purposely sign up to lose money? And the only way that that bond is going to make money is if they cut interest rates more. So they can raise interest rates in the United States, and that's what's caused them this issue. So they start cutting interest rates. Yeah, that's good for bonds. So maybe they raise them and then they're going to cut them again. Well, when it gets down to basically zero, there's nowhere else for them to go other than negative. And I think a lot of people are wondering, does the United States go to negative interest rates? That would ruin all the banking system. So I'm going off on a tangent now, but I would just say stay away from bonds, or just be very selective the way that you look at it. And if you're only given a choice between stocks and bonds, I would lean more towards stocks, even though there is absolute risks in both of those. Over time, stocks are going to outperform, and in an inflationary environment, come hell or high water, historically, stocks are going to give you a better return than bonds are. So if I'm a younger individual and I'm forced to pick one or two bad options at the moment, I'd rather pick the one that gives me the longer term most upside. Or if I'm going to, have all that pain, at least let me have some of the reward of what it'll be over time.
Yeah. So I'm going to kind of try paraphrase some of this stuff, because I'm learning a lot on, to be honest, the bond side of things has confused me. So, and we don't need to go too in depth, because I don't know if there's a lot of value in all the nuance, but a few add-ons is the bond market is massively larger than the stock market, right? And I didn't know that, when I first got into investing, but the bond market is the dog, the stock market is the tail, and the dog will wag the tail, not vice versa. And then what you had talked about, the bond being, you have a very defined upside. Like you said, best case scenario, they pay you the coupon rate, you get your money back. That's a win. You can't do any better than that. So I guess when I'm looking at that, why does so much money pour into bonds? Like the way you've outlined it, it seems like if you were to be like, Mike, pick one, I'm going to be like, okay, I'll pick stocks.
Yeah. So it's,
sorry.
Go ahead.
Well, I was just going to say, but the bond market is massively larger.
Yep. And part of that is because pension funds, retirement plans, other things have mandates to offer it. And there's a reason why those have been kind of told and taught to people that this is where your safe money goes. And a lot of these investment strategies, I'll use an example of a target date fund. Are you familiar with what a target date fund is? It gives you like in the United States, it's like, oh, I'm going to retire in 2055. I'm going to have stocks, I'm going to have bonds, and it's going to rotate from stocks to bonds. I never have to touch it again. I don't have to rebalance. I just save into it. It's a one size fits all. You pick the date that you want to retire and it will take the risk down. Well, again, look at 2022. The risk on all those things, you can go at the one that's 2020 to the one that's 2060, and the returns are pretty much the same. And the risk profile for someone that thought that they were about ready to retire, when they lose 20 to 25% of their portfolio, they're going, oh my gosh. And so I think for a lot of your listeners, they're not in that situation. That's good. But to give you another thought of like, why is fixed income or why is bonds so much bigger? It's because there's mandates. There are mandates that they have to own a certain amount. So like the biggest pension fund in the United States is CalPERS. So it's the California, I think, teachers pension. And they have a mandate that they have to have a certain amount of fixed income. And so for those investment committees to make those changes, it takes years, a long time. And they're not going to just say, hey, we got to walk away from bonds, because bonds have been so good for so long for these places that that's part of their mandate. They're not just going to walk away after one bad year. But what I'm telling you is it might not be just one bad year. And I think that will really shake people if you see bonds are a negative return for multiple years. But if you go over the last 3 years, last 5 years, basically treasury bonds haven't made any money. They haven't moved because they gave back all the return. Because again, there's not a huge upside to these things to start with. So when you have one of these dramatic moves, it wipes years of earnings off, years of income. And Luke Groman, who is a fantastic kind of macro thinker, on November 4th, put out a tweet that stuck with me and I wanted to share because it is tied to kind of what I was talking about earlier. He goes, I do not ever recall before seeing GLD, which is the gold ETF, outperform TLT, which is the ETF for long duration or long bonds, so that 20-year plus that I talked about earlier, by nearly 5% in a single day. So gold was up almost 4%, and that bond was down 1%. That spread, he'd never seen that in all his career. And he's late 40s, early 50s. He's like, I've never seen that before. So this idea that, well, the past is always predictive of the future. There's always that past performance doesn't guarantee future results. 2022 is a weird year. It's been really weird where it's broken a lot of these rules of thumb that advisors and kind of financial gurus have told people for a long time. And I think that's one of the things that I've tried to explain on my podcast and other places is you need to be adaptable and flexible with when the information changes. You need to be able to change your mind, and that there's a fine line with that, right? You can't just like be the person that is like the used car, person that waves in the wind and just blows over, right? Like you never have any sort of direction, but you also need to understand like, what do I actually own? And I think that's the biggest struggle is we've tried to make it so simplistic that, hey, more risk, own more stocks, less risk, own more bonds. And people are like, yep, I get that. But there's no nuance beyond it. And I know that that's just hard because the education's not there. But what I would encourage people to do is you can own other things other than stocks and bonds. And you can look at even within stocks, right? So everyone will say, well, stocks are down. Well, what stocks are we looking at? What about energy? Energy's been beaten up and left for dead. So ExxonMobil's up 90% this year. Do people know that? They got kicked out of the S&P 500 for Salesforce. And you know what's happened since? Salesforce has gone straight down and Exxon has gone straight up.
I remember 2020, like oil went negative.
Yep.
Right? And all those energy companies, like when you look at them, some of them have like quadrupled. If you like, you're cherry picking the dates, the depths of 2020, all the way to the peak of 2022. But.
Yeah. In energy in the S&P 500, the biggest factor of the S&P 500 is tech, because tech has grown so big. So if you look at year-to-date numbers, and these are fairly accurate by a couple days since we are recording this, Netflix is down 71%, Microsoft is down 30.5%, Amazon's down 40%, Google's down 35%. Like those are, Amazon is supposed to be this company that just continues to grow, and like there's not as much risk there. but there still is. And so the S&P right now is mainly, call it 25 to 30% technology names. And so tech is going to drive all of that. And then it's only 5 to like 7% in energy, where it used to be flip-flop of that, right? If you were to go back to the early 90s. And so sometimes it's just doing something that is different than what everyone else is doing. And so if I had to say, I have to own stocks and only stocks, and let's say in my 401k, I have the ability to have a sector fund, maybe the things that are like materials and energy, the things that no one's loved for a long time, maybe I want to own some of those, because those structurally right now, no one around the world wants to dig new wells or, do the exploratory big capex expenditures, because every government around the world says we want green energy and we want all this fossil fuel stuff to go away. Yet the world is short energy and doesn't have enough to heat lots of places, especially in Europe, because of stuff going on. So the world is going to need energy for the foreseeable future, and we don't have enough at the moment. So what does that mean if we just take it simplistically and go back to first principles? There's not enough of it, and these companies that make it are going to be able to demand higher prices. They're doing exactly what they should be. They're running like crazy to make this stuff. And so we can use the ESG narrative and green, and this is bad for the environment. I would push back that, for humans, the consumption of energy is paramount for the quality of life. And so what we should be doing is trying to have more cheap energy so that we can have more human flourishing. And the idea of this constriction of energy consumption is actually going to kill more people than the ability to have cheap energy over time. And most fossil fuels are needed for anything renewable. You can't make any of these renewables without fossil fuels. And so we need to have this period where we're not trying to just kill everything. You have to have it like run in parallel at the same time. And so what I think is happened and happening is so many things. We're trying to get rid of these fossil fuels. And I think that's actually an opportunity from an investment standpoint. So it's worked really well, but I don't think that story is necessarily played out. So that's me ranting on lots of other ideas there.
Yeah.
Too.
Well, it's interesting being up here in Canada, our TSX, there is a lot of energy plays, and it is, performed better than other indexes. And even the part of the world that I live in, sometimes we feel like we're in a bubble, because when you talk about resources, commodities, energy, it's like, that's where I live. So it's like, I'm on an island over here in terms of like, my wife is a recruiter and she could not be busier. Like all of those companies are like, the world needs like way more of everything we produce, So it's funny, like when some things on one side, all those companies you just listed are laying off by the tens of thousands in the tech sector. And then we flip over on the commodity side and the energy side, and it's like things are running pretty hot.
Yeah, there was some stat that there was more people drafted in the MLB draft than there were like engineers going into energy and oil and gas, which was insane, because you think about Major League Baseball, highly specialized, very limited subset, and you have the energy sector, and like all the graduates I think it was a petroleum engineer is what it was. Less petroleum engineers graduated last year in the United States than were those that were drafted in the Major League draft. So that just tells you there's just not enough people that are talented and knowledgeable in the space. So I'm not surprised that your wife can't find people, because they're just not out there. They're retiring, or they left permanently because oil was negative and they couldn't make any money and they finally gave up and said, we got to go do something different and take our skill set elsewhere. And yeah, it's kind of wild.
It is. It's been wild to watch. Okay, any other buckets that we want to dive into? So we did stocks, bonds, kind of looked at some of the sectors within stocks.
I think commodities, and one of the things that I've talked about, and I'm happy to share if you want to plug a podcast that I've done talking about the idea of either trend following or managed futures. And so those are slightly different things, but like trend following is a strategy that have been made popular. A paper by Meb Faber back in 2006 called a quantitative asset allocation, and it was re-upped in 2013. But the idea is that you're going to own different things, and you can just put some rules in place of when you're going to own things and when you're not going to own things, and you can just sometimes sidestep. Maybe we don't need to own bonds right now. We'll just hold cash. And you know what? Cash has not been the worst thing to own in 2022. But the idea of managed futures or commodity trading advisors or CTAs, these are weird things that basically it's an asset class all to itself, where it trades futures. You can go find ETFs, you can find mutual funds, but what they do is they trade stocks, bonds, currencies, and commodities, and they can make money on the long side. So when those things go up, or they can make money when those things go down. They are not correlated, so they don't move the yin and yang, right, to stocks or bonds at all. Completely independent return stream. So you think about the ingredients in the cupboard. These are completely different, and will be. They do awesome whenever the S&P is down 20% or more. They do really well, one of the best diversifiers out there since the 2000, and have had an awesome year this year because of big moves. Currency, you're not really going to get a lot of currency exposure in any stock and bond investments. So the US dollar has been the strongest currency in the world, crushing everything else. You made money on that. Energies, it's made money on those. Going short or negative when the bonds go down in price, it's made money. So like those things have done really, really well, and it's a good diversifier. So again, add that ingredient to your bucket, but you need to allocate to these type of things into the future because you don't know when they're going to work. So case in point, you can look at a year where it might make 1%, 2%, 3%, and the S&P is up 30, and you're gonna be like, why the hell do I own this thing? It sucks. And that happens the next year, and it happens a year after that. But this year it's up 50%, or it's up 30%, or it's up some. It's all about having the ability to take money from something that's doing well and rebalancing. So taking the winner, taking some of that money and putting it back into things that stink, putting it back into stocks and rebalancing and saying, hey, every quarter, come hell or high water, I'm going to take the thing that's doing well and putting it back in the thing that stinks. And you're going to keep that allocation about the same over time. And you know what will happen? You're going to feel like every year you don't make as much and you're not doing as well as your neighbor. And then there's years when you're down and you're like, oh, I'm losing money. But then you zoom out over 20 years and you're like, actually, I compounded at a higher rate than these other people. And I didn't have the highs and lows. But if you can just continue to grind out returns, like that will, do really well for you. And so what I would always encourage, I think the overarching thing is you don't have to think that, owning energy is good or owning managed futures is good or owning commodities is good, but you need to have something that's going to structurally work differently than stocks and bonds. And I think that is like the biggest piece of advice that I can give. And this is a really good year for that to understand it. Whether you're a gold person and gold's not done great this year, but it's down, 8% or something, that's still a diversifier. It's still done better than owning bonds. And it still is going to kind of march its own beat versus stocks and bonds. So that to me would be kind of the thought process is you need to figure out some other asset class that you can put in there adjacent to kind of the core holding that's going to be stocks and bonds. I mean, you're a big real estate guy. You can look at real estate. Sometimes it's harder to get that allocation because it's not, kind of in the traditional markets, but there are things that, will do well over time that are outside of stocks and bonds. So I think that to me would be the main thing I would focus on.
Yeah, that's good advice. One thing that I do is, in times like this, I journal a lot just about, how am I feeling, even to stuff I don't have exposure to, like seeing a stock like the crypto, the FTX, I have nothing in it, $0, no exposure, but I still follow that and I see it collapse and I'm like, wow, how would I feel? And, you can take lessons from that. Like what you're saying is, a small allocation. In some years it's doing not much, but other years, it kind of saves the portfolio. My question would be, you're sitting across the table from a client, and how do you get them? Like, oftentimes those investments in those pieces are when things are the worst, right? Like in hindsight, an investment in various oil and gas and energy companies in April of 2020, and like you look like a genius. But making that investment back in that environment, like I remember what the news felt like. Like it was like, the futures market, like there was nowhere to put oil. It was negative. Like people were like scrambling, right? So how do you, I guess, take action in the face of that much like emotional adversity?
So if it makes you sick to your stomach as you think about investing in it, it's probably a good time. So case in point, that I'm a big Bitcoin person, and it is absolutely blood on the streets, like horrible for a lot of people. My thesis, I'm Zen mode. Like does not affect me. I'm fine. I think that to me right now is the thing that is screaming at you. Pain, 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 pain. Everyone's going to go away. And it might be really boring actually for, the next 6 to 9 months as it chops around and nothing happens. But you know what? We revisit this conversation in 5 years. It's going to be like, oh, that was so obvious. Why the hell did people buy $16,000 Bitcoin? I don't know where it's going to go price wise, but to me, it is looking at what is absolutely making your skin crawl to think about owning, and then understanding, okay, what environment does this do well in? And so for energy, I mean, the thought was, are we going to continue to use it? The answer is yes. Are we bringing more supply online? No. And it's one of those things that it was a time and place that was unique, where basically the world shut down and we didn't need as much, and there was nowhere for it to go. But did we think that we would open back up the economy? I don't think anyone thought it was a permanent situation, that they were going to be closed. And so I would look at that in the same way. Like, do we think governments around the world are going to provide easy monetary conditions in the future? Because that's what they've done historically for a long time. And I believe wholeheartedly that they will continue to do that, because it's a lot harder than acting responsibly. Just devalue your currency. You know what does really well when you increase the money supply? Bitcoin. So like to me, you have to look at these things as, if it's a scenario that the thesis is unchanged, and you don't have to have, you know, the CFA or the wild, you know, 12 monitors and all the charts and stuff. Sometimes it's just trying to understand, like, you should have, as an individual, you should have a core portfolio that you're not really adjusting that much, right? You need to have something you stick to, come hell or high water, you rebalance, you do that. And if you then want to take a portion of that and then make these kind of tactical tweaks, do that, but don't do it with everything. So I think that needs to be a clarifying piece just as we go through this. Like, I don't want people to be like, well, I own stocks, and then Isaiah said this, and well, yeah, again, you need to have a core piece that you're like, hey, I'm going to save into this and it's going to go forward. But then there can be a portion of it, call it 10 to 20%, that you're going to say, I'm going to be tactful with how this is allocated and make adjustments over time. And maybe that to me is okay. You can do some of those things to make adjustments, but you have to talk to people when times are really good and you have something that has just absolutely crushed it. So right now, maybe it is looking at, you know, managed futures, because it's done really well. Take money from that and put it back in. And let's say you have stocks, go put it back in the tech stocks that have gotten crushed. And you know what? They might get crushed again for another quarter. That's okay. Harvest the money that you made somewhere else and put it back into it.
Yeah, I like that. I tend to be contrarian, even though it's very difficult, you know, like I'm kind of nibbling onto some tech, but like you say, like, you know, we could see more downside. I think back, part of the reason even for reaching out, I graduated in 2008. And so that was my like foray into like, hey, yay, I'm an adult, I have a paycheck. And it's just like things are crashing. In hindsight, you know, with the benefit of years later, and you talk to people that, you know, had all this like sort of liquid cash on the sidelines, and you can't time the bottom. So I'm not suggesting you can. So this was partially luck, but, you know, early 2009, they load into the market, you know, and they did amazing. So like just that ability to keep the emotions in check, you know what you're investing in, and then still follow through even when headlines are the worst. That's kind of the take home I think we're getting at here.
Yeah. And my big thing is you need to have some sort of baseline that you stick to, that, hey, this works over time. And historically, the stock market has gone up, right? It will traditionally recover. That is something that has been a long-term good allocation for people to have. Now, I can show you all kinds of fancy fun graphs of like why 100% actually doesn't make as much sense. And adding some of these other ingredients actually compounds at a higher rate and lowers your risks, and can like just do so much better. But if you're like, I'm paralyzed with all this stuff that was just said, and you're like, I'm young, look at the stock market and say, I can save into that. And if I'm just consistent and don't, you know, pull something off in the worst time frame, you will be okay. There are ways to improve it, absolutely, and we can get nuance, we can go all different directions. But yeah, I think the idea is you want things that are complementary in different environments. And historically, if you look at something that has done really crappy when something else has done well, those are actually a better marriage than things that kind of do well together over time. And then all of a sudden it's going to do bad in the exact same moment. Like, you want the zig and zag to be something that's structural, that actually doesn't really change that much. And that's hard to find. And people have thought that's been stocks and bonds, but the data's been out there that that's not been the case. And so that's where I really fault a lot of advisors that just don't understand and look at history, for knowing that there are a good rationale and good reasons for owning other things.
Yeah.
Outside of that. So
Okay. I know we're running up tight on time. One last sort of area I wanted to get your thoughts on. You had touched on it around monetary policy. You got to go dig the crystal ball out. I know you said it's broken, but I'm sure you can buff it up. Interest rates, because that seems to be like the thing that's moving stuff right now, right? And interest rates, as you said, fastest rate of change that we've seen. Where does this go? Are we going to be under, like, everyone is hanging on CPI inflation data, it seems like. Are we just in for high inflation? Is that going to correct down to the 2% they're targeting?
I think the consensus view is eventually everything recorrects back to 2%. And again, we say, what's non-consensus? That inflation stays higher for longer.
Yeah.
And right now, the US dollar runs the world. So when we raise interest rates, we absolutely crush so many other economies. So Jay Powell, who's the Federal Reserve Chairman, is going to continue to raise rates until things break and break badly. And since we've talked, the UK pension system almost went insolvent. It had a Lehman type of moment. So Lehman was a bank that went under in 2008, where they had to rescue because they had levered their bonds that never go down. That did go down. And then when they had a collateral call where it's like, hey, please send more money because you're going to lose this position, they send more money, it goes down more. So we've started to see little cracks, and that is a bigger than a little crack with the UK and breaking that. But they're going to continue to raise rates because they have been tasked with bringing down inflation. And so come hell or high water, they're going to continue to do that. And they've said they want to see unemployment go up. And they want to crush demand. So if more people are unemployed, they're not going to spend. And so the problem with all this is they're looking at indicators that are lagging indicators by a month or two. And so when they make these decisions and people do start to get laid off, it's going to take a little while for it to run through the system. So the short, TLDR is there is more interest rate increases likely coming. And what will happen, and I will I'll give you an analogy, and this is not the doom and gloom, but let's say we're hanging out in a cocktail bar, and all of a sudden all the doors shut and they suck the oxygen out of the room slowly at first and then really fast because they want us to stop talking. They want us to be quiet. So people start falling on the ground, doing this, and all of a sudden we can't breathe, right? There's no oxygen. So what the Federal Reserve is sucking the oxygen out of the room. They don't want everyone in the bar to die, right? They want us to live, but they want to make sure that we go home. Lights went on, get out of here, go get your Uber, go home. And so they're going to rush in and put the oxygen mask back on. And what that's going to be is the pivot. So people talk about the Fed pivot. We don't know when that happens. No idea when that happens. And all the pivot is saying, oh, okay, we're going to ease monetary conditions. We're going to create stimulus because we've kind of broken things. So if one was to say what's going to happen over the next 6 months, it probably is a continuation of what we've seen right now. And then we'll see how bad things are. But don't be surprised if there's more pain in bonds and more pain in stocks. That to me is kind of the base case. And what you've seen in 2022, I think it just continues to kind of grind the same way, where inflation is higher, inflation is sticky, commodities do well, and the things that have done well in 2022 will kind of continue to go that way. And like you said, if Russia shoots some missile into Poland and starts more stuff, that is the wild card. We don't know that kind of stuff that happens. But at some point, they will have to come in and strap on oxygen masks, cut interest rates, stimulate the economy to get things back going again. And again, don't know when that happens, but that will be a time where you'll see this turn. And recently, I think it was last week when CPI came in a little bit lighter, the NASDAQ was up like 5% that day. So everyone's waiting for that to happen. And the NASDAQ just being tech stocks. Everyone's waiting for this to happen. If I am Jay Powell, if I'm the person that's trying to, crush this and get things under control, and I see that, I'm thinking they're ready. They're too ready. We need to drag this out a little bit longer. We need to inflict a little bit more pain. S&P is not even down 20% anymore, right? It's bounced back. So, it's not been as bad as a lot of people. It's just been a long grinding slower where it's just been painful. So I think we'll see that more in the future. And it's not necessarily doom and gloom, because if I'm a veterinarian and I'm saving and I'm young, keep doing what you're doing, keep saving into it. If you have a good, stash of excess reserves and cash, and you see a big move where it's a lot of pain, maybe you accelerate what you're saving a little bit more, withhold a little bit more from the paycheck, and you continue to do that, and you will be okay. Because once the turn does happen again, it's going to be anything that's risk on is going to take off. And I think that's what a lot of people are waiting for at the moment.
Yeah. I was watching the market that day. The biggest, like, it was a huge 2-day rally, just went vertical. So people, are just sitting there, fingers ready on the buy button. So anyway, Isaiah, this has been phenomenal. I love this stuff. I hope we're giving good value to the listeners. I guess as always, we'll wrap it up here. And I guess last word goes to you. Anything you want to leave our veterinary community with?
You can make it as simple or as confusing as you want. And I hope I wasn't I think there's nuance and nuancing be needed. But what I would encourage everyone is look at what you own. And I would limit the exposure to bonds, and I would try to find something outside of stocks and bonds that I can own over time. And I think that will, benefit you over the next, call it 3 to 5 to 7 years, because I think some of this stuff is going to be around longer than just months. And so that would be my encouragement. People always know that I'm going to tell them, Bitcoin is still around. It will still be here in 5 years. It's not dead. But it is absolutely painful at the moment for, I think, a lot of people that maybe didn't understand why they owned it. So, but nothing's changed. The thesis is still there. That's what I'll leave you with.
Thank you for listening to the Veterinary Project Podcast. As a recap, on behalf of our hosts, the Veterinary Project Podcast will be releasing new episodes weekly. So be sure to tune in as we bring you more conversations aimed at helping you enjoy a life well lived. If you enjoyed what you heard on the show and you want to stay in the know, please like, love, and or subscribe to the podcast on the listening platform of your choosing, as we're available on all the usual suspects. If you know of others that may benefit from these conversations, we'd love it if you please share the show with them, as this will help us grow our community to reach more and more veterinary professionals. Speaking of which, if you are a veterinary professional and would like to get connected with more like-minded individuals who are joining us on this journey, please send an email to the veterinaryprojectpodcast@gmail.com, and we'll invite you to be a part of our private Facebook group. General feedback, requests for information, or perhaps requests to be a guest on the show can also be sent to the veterinaryprojectpodcast@gmail.com. Dr. Michael Bugg and Dr. Jonathan Light, thank you for listening to the show, and we'll catch you again next week for another episode of the Veterinary Project Podcast. Bye for now.